Happy New Year and welcome to the first newsletter update of 2018. I'm Julia Lee, an equities strategist at Bell Direct. And this year it's all about understanding the bull market that we're in and what part of that bull market cycle that we are in. In the later part of a bull market, it's growth that outperforms value as well as yield. And it's sectors like the materials, the energy and the industrial sectors which outperform areas like telecom, utilities and property, which usually underperform. With global equities still outperforming Australia and with the Aussie dollar expected to fall in 2018, I really do think that investors should look at overseas exposure once again this year. And with exchange traded funds, it's easier than ever, and Australian investors can easily do this through global ETFs, which are traded through our local Australian stock exchange. Don't forget that interest rates are rising, and that means focusing in on companies with solid balance sheets and low refinancing risks, because refinancing costs are rising throughout the globe. And of course, in the later part of a bull market, it is commodities and energy which does tend to run hard. So in terms of commodities as well as oil remaining positive in 2018. Let's have a look at some of the statistics for January. The benchmark ASX 200 index down 0.4% in the month to date so far. Unfortunately, no real inspiration from the small cap or the mid cap indices on the Australian share market, but note very strong performances coming through from the US stock market once again, up 6% in the month to date so far. Japan, which is up 5% in the month to date so far, and China through the Shanghai Composite up by a massive 7%. The FTSE, which is more structured like the Australian share market with a strong emphasis on commodities, has underperformed global equities as the Australian market has. But look, the Australian market really does seem to be treading water ahead of that half-year earnings season, which kicks off next month in the month of February. Having a look at some of the top and bottom performers for the month, and the top performers include the tech stock Altium, which is not surprising given that tech stocks are performing so well around the globe, A2 Milk as well as Flight Centre, which of course are in an upgrade cycle. On the downside though, we've seen Retail Food Group underperforming, Australian Pharmaceutical Industries underperforming, and also Fairfax. Look, a lot of these stock moves are driven by earnings expectations, especially around this half-year earnings season which kicks off in February. So let's have a look at this February half-year earnings season and some consensus expectations. First of all, in this financial year, the market is expecting to see earnings growth of 7% for the Aussie share market. That's a little bit of a step back from FY17, where we saw around about 12% growth. But driving a lot of that growth and doing the heavy lifting is once again the resource space. If we have a look at resources, we're expecting to see growth of 26%, and this is also the most likely source of outperformance and upgrades. The industrial sector up by 2%, and the banks expected to grow by around about 2%. January, of course, is confession season, and the good news is we've seen some positive confessions, some upgrades coming through from the likes of Lovisa, LOV's the stock code there, Noni B, NBL, Adairs, ADH, Bellamy's, BAL, as well as Certex, SRX, the stock code there. On the flip side, some negative updates coming through from the likes of Retail Food Group, RFG, Australian Pharmaceutical Industries, API, as well as QBE Insurance, QBE, the stock code there. Of course, with it being reporting season, we also focus on the possibility of companies to offer back a capital return. And part of that is around franking credits. So revisiting this piece by Macquarie, which looks at large franking balances on the Australian share market. And some of the big blue chip companies with big franking balances include BHP Billiton, Woolies, Commonwealth Bank, Westpac, as well as TPG. This, of course, increases the likelihood of a special dividend by these companies to help utilize some of those franking credits, as well as possibly a capital return. Having a look at the mining space, which has been behind a lot of expectations around outperformance and upgrades. Looking at Shaw and Metals and Minings, they like BHP, Fortescue and Iluka. In the aluminium space, AWC, Nickel Exposure, Western Areas, as well as Independence Group. Look, one of the features last reporting season were that mining services companies really seem to have been on the up and up. Not so much in terms of earnings, but more in terms terms of outlook. So this piece by Deutsche Bank is quite interesting. It has a sell on CIMIC and Monadelphous, which of course has performed quite well over the last 52 weeks. They have a buy on Downer EDI as well as Worley Parsons. And in terms of this half-year earnings report, they're expecting Worley's to positively surprise. What they are looking for is for the dividend to be reinstated, strong cash flows, as well as a positive outlook coming through from Worley's. Monadelphous also expected to provide above market expectations, but given that the stock has run hard and ahead of expectations, Deutsche Bank have a sell on Monadelphous. Now to having a look at some of the wine export data. Look, one of those companies that has been running quite hard in the last few weeks of January is Treasury Wine Estates. And it's not hard to see why. If we have a look at the Australian wine export data for December 2017, what we have seen is that export volumes from China are up by 67%. In the US, so down by 31% for the month compared to the previous corresponding period. What's interesting is that not only is growth strong from China, but also around Asia and in China, we see above average prices coming through. So for China, we managed to sell on average for $5.58 per litre, and Hong Kong $14.48 per litre, compared to the US, where we only get an average price of $2.51 per litre, and Canada $3.06 per litre. Of course, that's a positive for Treasury Wine Estates, and that would be a buy at the moment. Treasury Wine Estates comes out with its result on the 15th of February. So China, a key driver of Treasury Wine Estates, both in terms of volume and in terms of margin and pricing. Looking at Morgan Stanley now and the media, internet and tech sector. Look, ahead of earnings season, it's nice to revisit some of these stock recommendations. And Morgan Stanley has an overweight on REA, as well as Fairfax, Domain, Seek and WiseTech. It does though have an underperform on Seven West Media, SK Telecom, Southern Cross Media, as well as Prime Media. It does see potential upside for 9NEC, as does the rest of the market. It sees a good first half as well as an outlook, and says expect more merger and acquisition activity in this space for 2018. Finally, it has been a slow start for the new year, but the Australian share market, I think, is just simply treading water ahead of the half-year earnings season in February. Hopefully, we will see enough positive outlook statements to give the Australian market another leg up in the month of February. But globally, we are in the latter stages of a bull market cycle, and that usually means that growth outperforms, commodity outperforms, and oil outperforms. Of course, here locally, we will be very much focused on the fundamentals as well as those earnings reports in February. And if you need an earnings calendar, please go to the Bell Direct website and have a look at the earnings calendar there for the half-year February earnings season. I'm Julia Lee from Bell Direct. Hope to see you next month, and all the best in the new year. I hope your stock portfolio performs well.